Are you often caught choosing between buying or selling options, unsure which one gives you the better control? There is a smarter approach, option spread, a strategy that helps you limit risk, reduce cost and align with your trades with your market view. So in this video, we will cover what option spreads are and their key types, why spreads offer more strategic flexibility, and how they compare with naked option trading. So without any further delay, let's get into the video. So let's see what are option spread. An option spread is a strategy where you buy and sell options of the same type, either both calls or both puts on the same underlying, but with the difference in strike price, expiry or both. The goal is to create a net position that helps you manage risk, cost and market exposure more efficiently. Let's look at the three main types. The first one is vertical spread. In a vertical spread, you buy and sell options with different strike prices but with the same expiry date. Let me explain with an example. Bull call spread. Buy a lower strike call and sell a higher strike call. This is used when you are moderately bullish. Bear put spread. Buy a higher strike put and sell a lower strike put. This is used when the market is moderately bullish scenario. Let me tell you the key characteristics of vertical spread. Same expiry, same type call or put, different strike price, defined risk and reward. The second type is horizontal or calendar spreads. A calendar spread involves buying and selling options with the same strike price but different expiry dates. Typically, you buy a longer dated option and sell a nearer term one at the same strike price. This is used when you expect the price to stay near a level short term but move later. The key characteristics of calendar spread: same strike price, different expiry, takes advantage of time decay, and sensitive to IV. The third type is diagonal spreads. A diagonal spread is a mix of both vertical and calendar spreads. It involves options with different strikes and different expiries. It's more flexible and often used to manage both time decay and direction. Now let me tell you the key characteristics of diagonal spread. Different strike prices, different expiry dates, more customizable, and requires a good understanding of the Greeks. Now let's see why we use option spread. Spread helps you trade smarter with more control, better risk management and improved capital efficiency. Here is why traders use them. The first one is defined risk and reward. One of the biggest advantages of option spread is risk clarity. Each spread has a clearly defined maximum profit and maximum loss right from the moment you enter the trade. This removes guesswork and allows you to plan your position sizing and expectation more professionally. The second point is efficient use of capital. While naked option buying is typically cheaper due to lower margin requirements, spreads offer better capital efficiency than naked selling. We are still selling an option, but since it's part of a spread, your margin requirement is significantly reduced. So if you are looking to trade defined risk strategies without blocking large capital, spread strikes the right balance. The third point is tailored for market condition. Another key strength is flexibility. You can construct the spread based on the market view. Bullish, use a bull call spread. Bearish, go with bear put spread. Expecting sideways movement, try calendar or diagonal spreads. Whether you are directional or neutral, there is a spread strategy that can align you with your expectations while keeping your risk capped. The fourth point is better probability of profit. Spreads, especially credit spreads, can offer a higher probability of profit compared to naked option buying. For example, in a bull put credit spread, the market does not need to rise sharply. It just needs to stay above the certain level by expiry and you keep the premium. This makes spreads suitable for range bound or slow moving markets where naked option buying struggles due to time decay. The fifth point is theta and strategy customization. Option spreads let you manage time decay more precisely and build trades that match your market view. Want to benefit from time decay? Use credit spreads or calendar spreads where theta works in your favor, especially in sideways or range-bound market. Have a directional view but want to control your risk? Vertical spreads like bull call or bear put spreads gives you exposure to market moves, but with a defined risk and cost, making them a smarter choice than the naked buying or selling. In short, spreads give you better control over time, direction and risk, helping you to create the strategies that fit your outlook and capital. Let's compare the option spreads with naked option trading. Buying options is low cost but needs a big move, and theta decay works against you. Selling naked options has a better probability and benefits from time decay but requires high margin and carries unlimited risk. Option spread offer a balanced approach, defined risk, better probability and more consistent break-even points. Option spreads are a smarter way to trade with structure, discipline and better control over your trades. So in this video, we have introduced the concepts of spreads and why they matter. In the next video, we will dive into the most commonly used spreads, how they work and when to apply them, including credit versus debit and directional versus neutral strategies. Yeah, that's it for today. Hope this video finds useful for you. For more such videos and updates, don't forget to like, share and subscribe to our channel. So let us know in the comments, are you using the spreads in your trading or are you just getting started? Happy trading!
Trading and investing involve substantial risk and are not suitable for every investor.